I'm Scarlet Fu. Welcome to Bloomberg's Front Row. Today, I'm talking to Jonathan Lavine of Bain Capital, one of the world's leading private investment firms with $120 billion in assets under management. Despite the global pandemic, private investors sourced new deals and raised capital in 2020 with no interruption. But with asset prices soaring and 10-year returns in the public markets matching PE, the private investing business model faces new challenges.
There is definitely still opportunity out in the market. Valuations are beyond a shadow of a doubt troubling almost everywhere. But that doesn't mean that, with a large team looking at niches, maybe some contrarian places, that you can't find value and that you can't find good companies.
We talked about the prospect of increased regulation under the Biden administration, whether stimulus is widening the inequality gap for individuals and businesses, how to spot signs of deterioration in private lending, and PE's bad press. Here's my conversation with Jonathan Lavine. Jonathan, it's great to speak with you on Front Row. We know that the Trump era was great for private asset managers, but you now have valuations that are very high. You also have interest rates that are very low. Will the Biden era be better or worse?
Well, I think you need to step back a little bit, and it's not just about how markets did. I think the era we've come from, was marked by a lot of divisiveness. I'm not sure if the foundations of what it takes to have a successful economy, a fair and just society, things that help democracies flourish, was great during the last 4 years. And I'm optimistic about the next 4 years, but as we saw at the inauguration, it's incumbent upon all of us to make sure that we help make that happen. In terms of the markets, I still think that there's a lot of cards to see on COVID. There's been massive, massive human suffering. And I think we have not fully integrated what the long-term effects on that are. I am hopeful that over the next 6 months, things will get a lot better. I am hopeful that there is pent-up demand that will help create jobs, that will help drive companies to have real earnings. But, given how far we fell, I think sometimes what people miss is the snapback could get us to 85, 90%. And that's still a big drop from where we were. So I think there's a lot of studying to do. I think there's a lot of reason for us to think about measuring now, starting to think about what are the long-term effects? What are we going to do to change the trajectory permanently and not just rely on a snapback of pent-up demand?
Okay, so if that's the case, what is Bain's posture and appetite for risk? Would you characterize it as aggressive or cautious?
So I don't think I'd ever describe us as either aggressive or cautious. I'd describe us as thoughtful, and I would describe us as very company specific. Our firm has a global footprint. One of the things that has become incredibly clear during this time is that even though this is a global pandemic, this has been experienced very differently, geography by geography, and it's been experienced at different times. There is definitely still opportunity out in the market. Valuations are beyond a shadow of a doubt troubling almost everywhere. But that doesn't mean that, with a large team looking at niches, maybe some contrarian places, that you can't find value and that you can't find good companies that either need capital or have a growth plan that really can result in attractive returns. But I think there's less return to be had from market beta, and more it's going to be individual asset selection, whether that's in our life sciences business, our private equity business, our real estate business, or credit or venture, or any of our other businesses.
So you talk about this company-specific approach. Clearly, there's an overall hunt for yield with valuations this high and with rates this low. And people are looking for niche plays under the private credit umbrella. For instance, things like aviation finance. How exactly do you see that continuing? Will Bain need to be turning over more stones like in those places for more income generation?
So that's absolutely something we've seen in the market, but that's actually been a trend that started probably 10 or 12 years ago. And for example, we've been doing aviation finance for a long time, and we're setting up some partnerships even before the COVID shutdown happened. And I think that private asset management broadly, as it has matured, has developed into a wide array of assets, geographies, risk profiles. It's so, as with the stock market, went from being originally a few very large companies relatively to a whole bespoke series of ways you can participate in equities. I think you're starting to see that in the private markets and the credit markets.
We know that caution was not exactly rewarded in 2020. Do you think it will be rewarded in 2021?
Prudence is almost always rewarded in the long run. So yes, if you accessed a lot of beta last year, you did well. There's a lot of people that bought a bunch of things last year and it looked like, well, they've gone up, but if they still hold them and then they go down, then it wasn't actually rewarded in the long run. We as an institution bought we bought over $5 billion of private assets and made over $1.5 billion of private loans, but we sold almost $8 billion of things that we owned on the private side. So we recognize that you have to look at the valuation of each individual asset, look at industries, and think about where each geography is in a cyclical sense as well, and how insulated they are. I think the age of accessing beta is getting harder and harder. And I realize people have been saying that for years, and eventually we'll be right.
And of course, the backdrop to all of this is government support, whether it was monetary and continues to be monetary, or soon to be fiscal support as well. So let's talk a little bit about government stimulus. Is it really helping the average American and small businesses, or is it really helping the big get bigger, the rich get wealthier, and disproportionately benefiting those with capital to invest?
I think the answer is a little more nuanced than a binary, who benefits, who doesn't. Clearly, with stimulus, there's a wide swath of people who have benefited, but I do not believe that enough of it has gone to who needs it the most. And we can't have stimulus checks that people are saving and not spending. We can't have stimulus that drives markets up but doesn't result in more employment. Those are things that, on a policy sense, I think we need an integrated solution. And I think we need to think more on the individual and the family level. There's also, I think, the last stimulus, look, it came out quickly. There was unprecedented times, but I think there was a lot of friction created in how it got distributed. And I think that elements of direct payments, elements of a certain level of social support is really important for helping our society move forward, and doing so in the long run, not just to get past the pandemic. I think that the pandemic unearthed a lot of issues and disparities that people might have been aware of, but hadn't been fully aware of the depth of it.
Yeah, it exacerbated already big chasms. With regard to access to capital for companies, clearly there's been this huge disparity between who has access to credit. Smaller businesses don't have the same kind of access that big firms do, even those that are in risky and pandemic battered industries. Do you think this gap in access will continue to widen this year and next?
Unfortunately, I think that it's probably not going to tighten until people have a vision to the economy reopening. One of the reasons that you see this developing is the risk profile that we've talked about, which is those are companies that are most likely to be able to repay. And I think it is perfectly reasonable for the government to implement programs on smaller businesses that might be higher risk, that might see higher defaults. But that's a different calculus than a traditional loan. And I think that holistically, we probably need programs that are going to restart small businesses, that are going to provide a backstop to hourly workers who have been particularly hurt by this. but also recognize it is a good thing that capital continues to flow into even large companies. Could you imagine if no capital flew, no pun intended, flew into the airlines? If we didn't see capital flows to support airlines, to support restaurants, to support a lot of the service industry. So I think it's a two-sided coin, and I think it's an and, not an or.
Understood. With regard to the low interest rate environment that we have now, we've seen pension funds and other cautious investors really aggressively allocate into private assets in order to get more returns, and they're really moving up the risk curve. Is that a wise move?
When you think about the risk premium you get it for the risk of the company, the subordination you take, the length of time you're locking up money. One of the, I think, mismatches that has existed in the markets for a long time is coming out of '08, people were overpaying for liquidity. People were overpaying for the ability to be able to sell out of something. Pension funds, healthcare programs, they're investing for the next 25 years. Universities are investing for the next century. And therefore, getting an extra premium for locking up your money is actually, I would argue, better risk than a market-driven where everything would sell off at the same time. In our private lending portfolio, we saw the companies hold up. They were able to access capital, and we have a generally smaller middle market portfolio. And so I actually think people who got the premium for investing in that space were really well rewarded last year.
So when the private lending market perhaps starts to deteriorate, where will we see the first signs of it? In what industries, in what geographies, what kind of pattern will emerge?
I think that you'll probably see two things. One is I think that you'll just start seeing a lot of defaults, and defaults get press. The second thing is I think it will start with where people went deep in the capital structure, very, very deep in the holdco picks and things like that. So you will, as you see in the public market, see it move up the capital structure. I also think that you will see industries where either people who were not fully equipped to analyze them and purchase the beta of those industries, like some tech investing and things like that, where you're now seeing, you used to see people used to loan only against assets, and then it was a big deal that people started loaning against cash flow. When I started doing that in the mid-90s, that was a big deal. Now you're starting to see people loan against enterprise value. And that makes sense as long as that enterprise value holds up and you have the appropriate margin of safety. And that could be the phase where you see people were making debt investments with an equity hypothesis.
So would that be a red flag when
that would be a red flag.
Okay.
You would definitely start seeing that.
Okay, got it. I want to turn the page to regulation here. Is your industry, private equity, private credit, private assets overall, ready for more scrutiny? How are you preparing for it?
So I think that as any industry grows, it is likely to have more scrutiny, more regulation. That doesn't always necessarily mean it's bad. If it's thoughtful and it helps create free, fluid, transparent markets, that's good for everybody. If there's a set of rules that everybody signs up for that are thoughtfully created and evenly applied, I don't actually think that that's necessarily a bad thing. And private and asset management covers so many areas and so many geographies. It's inevitable that you will encounter new regulation, new ways of thinking about things across the globe. It's not only a US phenomenon. And that doesn't necessarily have to be adversarial. Everybody wants the same thing. They want fair markets, they want open markets, they want transparency. And I realize that may sound, Pollyanna-ish right now, but I do think that that there are ways where the industry can help everybody think about how to improve markets all over the place.
So what would an example of good regulation, thoughtful regulation for your industry look like? This has existed. I actually think an area where we have not participated, but I do think is an interesting space, is that there's been worked on being able to allow smaller investors to invest in the private asset world. It's
an area where in some high net worth and retail investors. That's not an area in particular we have focused on, but done correctly, providing ordinary investors with access to higher returning products is generally a good thing. But you want to make sure that they have different information and that they have information to make that decision, because historically these have been sold to very sophisticated, very investors with large teams and a lot of experience. It's not necessarily a bad thing if the result is more access to capital, more access to better investments, but there's some regulation around that.
Now, speaking of regulation, and you mentioned how it doesn't always have to be adversarial, your Senator, Elizabeth Warren, is really kind of gunning for private equity. What do you think she doesn't quite get or doesn't understand about your industry?
I'm not entirely sure she's gunning for private equity. I think that she is a very, very smart person who has a worldview on how markets should work that I think is an incredibly important voice. That said, I think that private equity, private investments add to market liquidity, add access to capital for companies that need it. And therefore, there's all sorts of positives there. I think as more companies that are public, it would have been unheard of 20 years ago that any of our firms would be public. And now, although we're private, most of our competitors are public. Let's
talk about the SEC. What does a Gary Gensler-led SEC mean for private asset managers?
I think that he is somebody who's incredibly experienced, incredibly smart, has a history of service, and I think will do a good job. I don't know him personally, but his obviously reputation precedes him. And, once again, I think we all want the same things, which is, free and fair markets.
Let's talk about the private capital industry overall, because I know that you've talked in the past about how private equity in particular doesn't do a great job telling its story. Why does PE get so much bad press?
I think that's changing a little bit, but I think that in industry where the P stands for private, just historically, people didn't know what it was. There weren't public companies. We don't advertise on television. I remember when I interviewed at an investment bank I had never heard of before because I never saw an advertisement for it on TV back in the 80s when I was starting out. So I think that as the industry has become more mainstream, I think people understand, like with any other kind of investing, there's a bunch of good stories. And of course, there's going to be some not so good stories. That is true of every kind of product Apple makes, companies conglomerate has, and in private equity. And I think that what we try to do is study the game tape all the time and see how we can do better with our investments, do better in how we interact with companies. And we use around our firm, if you walked around our firm, raising the bar and raising our game an enormous amount, because we think it's about continuous improvement, which, by the way, is how you create success in private equity companies. And I think that as people understand how many companies, and these are mainstream, I think some of the mystique has gone away and it doesn't seem as shadowy. Just like in private credit, people used to refer to it as shadow banking, and just putting the word shadow on anything. It turned out to be a good thing because there were a lot of funds raised that lent money to people when banks weren't lending money.
But shadow also implies dark and sinister as
Yes.
well. You mentioned making companies better. For a lot of people in the public, that means getting rid of jobs. And I think about the fallout from places like TXU or Toys R Us or Hertz. Do you think PE would have such a spotty reputation if firms like KKR and Apollo weren't so aggressive?
I think more broadly, I think that there are winners and losers. I actually think what people don't always understand is that private equity will take some of the hardest challenges and will, try to invest in companies that need to be turned around, invest in companies undergoing some sort of transformation. And those can often be high profile companies. And sometimes those don't turn out well. but I don't know a single private equity executive who doesn't feel every loss and doesn't, there is nobody, I have never heard anybody take restructurings, the losses of jobs, let alone bankruptcies, unbelievably seriously, personally, and really look to understand how there could be fewer and fewer of those. And I think when you look at the overall record of the private equity industry, I think that it stands up pretty well.
There's also headline risk as well. I mean, I think about Apollo's Leon Black and Jeffrey Epstein, or Robert Smith's legal issues at Vista Equity. I mean, these stories we've reported are hurting fundraising efforts sometimes, and they don't necessarily help the industry's reputation either. Do you think pension funds and other investors are justified in linking their investing to the decisions of individual leaders in the industry, in PE?
I think that when people invest in companies, in funds, in firms, they are assessing a broad array of characteristics, a broad array of things. Do I want to invest with a firm that's public? Do I want to invest with a firm that's private? Do I want a big firm or a little firm? And their perspective on the people across a whole variety of measures is absolutely relevant, as long as it is well-informed, fact-based and well researched. And that goes beyond the personality of an individual, because no one individual is a firm. Firms are made up of lots and lots and lots of people. And I think understanding an individual's place in the ecosystem of an entire team is also really, really important.
A lot of people who are well-versed in financial markets don't fully appreciate the differences between PE private equity and private credit, because there is often overlap as well. I believe Bain Capital Credit also invests in equity as well. How would you explain it to people?
It's really simple, I would say. When you think about how markets look, there's stocks and bonds, and that's what people imagine, and those are public equity, public debt. As the private markets have developed, they have developed to a private way to own companies. So instead of buying a share of a company, you buy all the shares of the company and you own it in a private way, just like any other private firm or a family business. And on the debt side, there used to be two ways you could access capital. One way is issuing bonds, and you would have to be big enough to be able to do that. And the other way is going to a local bank. And over time, those markets have developed where people can buy large amounts of, borrow large amounts of money or small amounts of money. They can borrow it from one person or through a syndication, so that there's private funds that are able to buy large blocks of your debt and negotiate individual aspects of what you may need, as compared to a cookie cutter public offering, which has to follow a particular generic format.
So I know that some of your peers, Blackstone, Apollo, Brookfield, they've all set their sights on this $1 trillion number, $1 trillion of assets under management within a few years. Are you in that camp as well?
No.
Or is there a point at which big gets too big?
So our perspective is there's nobody at Bain Capital who is paid for EPS or AUM. And we very much view our co-invest in the funds as an important source of how employees get paid, how we derive value, and therefore we want to grow in a way that we can make every investment that we think is interesting for our own money, that we think is attractive, and that we also think may provide lanes for some very, very talented people at the firm to do new things that are additive to the whole. But we approach it from the investment side, not the scale size, not the, we have over 100 billion of assets. We have a fair amount of scale, but we don't look to, a trillion or something like that. That's not necessarily a bad goal per se, particularly if you're a public company. That's what you're supposed to do as a public company. We're a private firm, and therefore approach how we view growing and perpetuating the firm differently than you might do as a public company.
So scale and being private, is that what distinguishes you from the other alternative asset managers?
I think that I think as well, our peers, which are a great set of very successful firms that you've listed through, I think that as we've grown, we've all sort of figured out who we are and what our style is, so to speak. I think the most important thing I wrote in an anniversary letter a couple of years ago, one of the things I think the credit business has done really well is understanding who we are, what types of investments we make and which ones we don't. And our people generally come from consulting and operational backgrounds across the firm. That's a pretty unique thing. I think it's more important as you look at the scale of these firms. I think that the ones that have succeeded really understand what is my investment philosophy, who are the people that compose the best team that we can put together, and how do we execute on that with a series of investors and limited partners who are interested in that offering. And I think that's how you develop the strategy.
So that segues naturally to our next topic, which is about the team that you have in place and how you think through a lot of this. Obviously, diversity and inclusion is top of mind for every corporate leader. Do you think Bain has done enough to make the firm, your portfolio companies, and the boards of your portfolio companies as diverse and inclusive as possible?
I don't think anybody has done enough yet. I think that while we are trying, and while it has been front and center with us for a long time, clearly there is more to be done. And I think that the way we get better at this is thinking about where we recruit, thinking about diversity of thought, diversity of education, diversity of geography, diversity of background. I think that everybody needs to provide this, to use the same creativity we've used to build our businesses, to make interesting investments, and apply it inwardly and make sure that we are all developing the most diverse, most talented teams that we can come up with that provide opportunity, that is a place that people want to work at, from all sorts of backgrounds, all sorts of geographies, all sorts of gender identification. And I think that it is something that we have made strides on, but nobody has done enough.
What do you think is the key internal friction point or points around setting policy on D&I?
So I think part of it is, believe it or not, just has been scale of the businesses early on. When I got to the firm, we had something like 14 investment professionals, and we were in Boston, and we didn't have the breadth of ability to look beyond our little enclave in Boston. I think secondly, to something we've talked about before, is making sure that people understand the opportunities available in our firms, because it's not just go be a private equity investor. There's all sorts of really, really interesting and important jobs, and making sure that by going out and being creative where we're recruiting and how we're recruiting, we're also creating networks that will result in those people bringing their friends in. And in this, you hear so much that there's a war for talent. So there's also a really, really important thing that, just like in the deal business, you want the funnel to be as wide as it can be. I think one thing that people have had a blind spot for is our recruiting funnels probably weren't as wide as they should be. And I think by putting effort behind it and making it front and center and treating it as a management objective, just like investment performance, I think you're going to see great strides in the industry in the next several years.
What have you learned from the pandemic experience in terms of how the firm works?
Think of all the best things that we've been able to do. We made dozens of investments last year. We bought companies, we sold companies, we grew the number of employees in the firm. We've had deals that got worked on by people from 4 different continents. All of those things are things that we want to make sure we capture. And then secondly, just one other thing is, we don't want to lose sight that this has just an enormous human toll, mental health toll, an economic toll, and how lucky we are to work at places like ours that we're able to implement those support systems. And we have always been engaged in our communities. But one of the things that we did is we made very large commitments, $100 million commitment to racial equity and social justice, and a $40 million COVID relief effort across the firm. Those are things that we would have done before, but we wouldn't have announced them. We just would have done it. We would have just distributed money, and we wouldn't have advertised it, for lack of a better word. But we felt we had a responsibility, and companies increasingly have a responsibility, to stand up and be counted and make sure people know what not just the firm, but the people at the firm are putting their support behind.
You mentioned you're in Boston, you're a Boston guy. Location seems to matter less now. There's an argument that Wall Street is decentralizing and New York City and other money centers like Boston are potentially less important, certainly now and perhaps, for time to come. As a Boston guy, what do you make of that argument?
I definitely think we're going to work differently. I think Boston is a unique ecosystem because of the schools and the universities that are there, and I do think that while businesses have figured it out and universities are successfully delivering education and accomplishing things, I think that there is a desire for connectivity. I think that, the pendulum swings both ways, and people have sort of made it work right now remotely. I think that people are going to have to rethink hub and spoke, types of operations, but you still need home bases. And you still need a way to think about bringing people together at sometimes mentoring and things like that. But I absolutely think the ability to create flexible work schedules, the ability to shift staffing across the globe and things like that are definitely going to be the biggest challenges and opportunities we all face, businesses of all kinds, over the next few years. And I think you see it in Europe as well, because I think this was going to be an issue with Brexit, as some folks wanted to move to their homes, their original home countries. And I think you started to see some, even in the credit business. We have a couple of very small offices in Spain and in Italy, and to service loans and do business in those countries. And I think you may see more of that too, because technology has clearly enabled the ability to do that.
Jonathan Lavine, thank you so much. Co-managing partner of Bain Capital and CIO of Bain Capital Credit.
Thank you.